I am Dr. Divya Verma, from Associate Professor from Guru Gobind Singh Indraprasth University School of Management Studies. I welcome you all to the lecture series on financial innovation and fintech. Today we are going to discuss about Indian financial system and financial innovation. This lecture series is going to comprise of the presently discussed most important topic, that is fintech. Fintech is affecting each one of us in daily life. It is one technological innovation because of which the financial sector has taken up a lot of growth, and financial sector is growing in a significant way. So to know more about fintech and to see how it has evolved and how it is affecting us in our daily lives, we are going to discuss about it in Indian financial system and financial innovation lecture today. So to begin with, we'll talk about what is financial system. The modern economy cannot exist without efficient financial system, which is defined as collection of markets, institutions, instruments and regulations through which financial securities are traded, interest rates are determined and financial services are produced and delivered around the world. As an integrated part of global economic system, we all understand that financial system determines the cost and quantity of funds available in the economy. It creates a mechanism for flow of funds between various economic entities like household, business firm, government, financial institutions. There are different approaches towards the classification of financial system. When we talk about the flow of money in the economy, there are different models which we have studied till now. There is circular flow of income in a 3-sector model or in a 4-sector model economy. Financial system comes as an integrated system which affects all the sectors. Like the important sector includes household sector, firms and the government. So this is known as a 3-sector model of economy. As per this circular flow of income or money in the economy, what happens that household provides the services to businesses, household provides the services to the government, in return they get factor payments, and the income of the household gets consumed. They buy the consumption, do the consumption expenditure, buy goods and services with the help of that, and whatever remains with the household, that goes as a savings. Where do we save money? We save money in the financial system. We save money in banks, we save money in stock market, or we invest money in stock market, mutual funds, insurance and all other various products and services provided by financial system. Similarly, the business also requires money for doing business. So they raise money from the financial system, they take money from banks as loan, they borrow money from the capital market, and they take money from various other institutions available. And whatever business will generate as an income will get reinvested in the business as well as will get reinvested in other sectors of the economy. Government, the role of government in both, with respect to both of these sectors is to collect taxes, is to pay for the benefit and the welfare of the people in the economy. And similarly, and so in this manner, the flow of money moves in the hands of household, firm and the government, and the center point is the financial system. So financial system will include all those institutions, all those services, products and assets which help a business which help a business and the household to allocate the funds at the right place. Now if we talk about the flow of money in the 4-sector economy, that means now we are also including rest of the world. We are also including the international markets. So household, government, firms and the international markets, all of them together, they integrate, they work in cohesion with the financial system of a country. So economic system of any nation works well with the help of financial system. So all of those components are a part of the financial system. So the financial system plays various functions which can be grouped into 3 different sets. They can be explained as monetary function, capital allocation function and controlling function. The monetary function basically is connected with the process of money creation in the economy and the process of transferring money between various economic entities. The capital allocation function can be explained in two dimensions. We can talk about the market financial system and public financial system. The market financial system enables to transfer surplus funds to the most promising deficit units and thus contributing to the economy. In the second one, that is the public financial system, it helps to gather funds that can be used to finance public goods, social services, social benefits, promoting and sustaining economic growth. Third important function is controlling function. So the financial system also enables to monitor the flow of funds in the economy regarding its effective usage. So the interaction between all the functions are multidimensional. Their efficient realization determines the development of the entire economy. So there are four main components of Indian financial system or financial system per se, which includes financial institutions, financial markets, financial intermediaries or financial assets and financial services. If we talk about financial institutions, we have banking sector and non-banking institutions. So the banking institutions constitute 65% of the total, flow of money, which is the investments in the economy. That comes from the banking institution. So banking sector further includes, we have different types of banks. We have commercial banks, cooperative banks, regional rural banks, small finance banks, payment banks. Commercial banks also include public sector banks, private sector banks, regional rural banks, foreign banks. So all of them constitute the banking sector. Then we have non-banking financial institutions, which include some organized ones and some of the unorganized ones. Now financial markets, which is a very important component, includes two main markets. One is the money market, which deals with short-term investments, and the capital market, which deals with instruments wherein the maturity is long-term. So the equity market, secondary market, stock market, derivative market, all of this is a part of the capital market. And money market is operated by the Reserve Bank of India, and it includes all the short-term instruments issued by for raising funds by the RBI. Then we have financial instruments or financial assets. Now these can be classified as short-term, medium-term and long-term, and these can be issued depending upon, they can be first time issued, so they will be called as primary securities, they can be secondary securities, or they can be some innovative or hybrid instruments which are issued from time to time. Fourth important component of financial system is financial services. These include fund-based services and fee-based services. So under the fund-based services, we have services wherein some fund is being transferred to the client, which includes hire purchase, leasing, factoring, housing loan and such type of things. Then there are fee-based services, which includes merchant banking, credit rating, where there is only consultancy or guidance being imparted as a service, but no funds are getting transferred. So of these four important components, financial markets are very important. They do affect the instruments, they do affect how market operates. And then there are regulatory institutions which you can say are heading these financial institutions of banking and non-banking financial sector. Then there is insurance companies, mutual fund institutions and a lot of other such institutions which exist under the institutional category. So we have regulators like SEBI, which governs the capital market, RBI, which is a central bank which governs the money market, and the banking institutions come under them, non-banking institutions would come under them. Then there is IRDAI, which is for insurance regulatory authority, and there is Ministry of Finance. So all of these are interlinked, they are supervising, regulating and ensuring that ultimately investors' interest gets protected and economic growth takes place. The function of financial system, there can be 6 core functions which can be performed by financial system, which includes transfer of economic resources through time across borders and among industries. Another function is risk management. Third important function is clearing and settlement of payments to facilitate trade. Fourth important function is pooling of resources, aggregating wealth into larger masses of capital and subdividing ownership in various enterprises. The financial decisions made on price information, dealing with incentive problems created by asymmetric information or the agency relationships. If we try to summarize the main functions of financial markets. So ultimately we understand that out of all four important components, financial markets are the biggest one or have a very important role to play when we talk about allocation of funds and making sure that the system is managed well. This includes attract and allocate savings and investments, financing function, setting interest rate and prices of financial assets, facilitating transactions, that includes payment function, risk management. So what constitutes the qualities of a good financial market? If we talk about a good financial market, would be very reliable, it would be having transparency, efficiency, liquidity, integrity and innovativeness. What is reliability? Reliability is connected with the way in which information is provided by the issuer of the financial securities to the investors in the financial market. Transparency is defined as the way in which transactions are concluded and information is disseminated to everybody. So markets need to be transparent. Financial markets can also be efficient and must be efficient, and this can be decided on the basis of three basic dimensions. The efficiency of allocation, that is, the capital is transferred to finance the best investment projects. The efficiency of transactions, which include sale and purchase operations that can be realized at the lowest level of transaction cost. And efficiency of information, that means all participants in the market have good access to information and they can take decisions based on that. If we talk about liquidity as a quality of a market, so liquidity is the possibility to undertake sale purchase transactions at any point of time at a set price without any additional cost and without any loss of value. Integrity in the financial market is very important because it sets the relation between financial institutions, supervising the activity of financial markets, creating the condition for their development and operations in this market. Innovativeness nowadays has come up as a very important feature of financial market. It is reflected in all the new developments that are happening in the market, all the new products and services that are being created. So good financial markets need to be innovative as well. Now let's talk about developments that have taken place which have led us to reach wherever we are now as an economy. Since independence, our country has taken giant strides in growth and development. The GDP of India rose from a mere value of 5 lakh crores in 1950-51 to about 147 lakh crores in 2020-21 at the constant prices of 2011-12. That means we have grown about 27 times with a CAGR of about 4.8%. Even if our GDP has grown 27-fold in last 7 decades, the per capita income has grown nearly 7-folds, and from about 14,000 rupees in 1950-51 to about 1 lakh to 2020-21. That means with a CAGR of about 2.9%. India now has more than 10 crore demat account, and people are nowadays accessing so much, reaching out to primary market to raise funds, as well as the investors are also attracted to invest in the IPOs. Mutual funds have clocked assets under management of around 40 lakh crores now. There has been a steady increase in corporate bond issuance, and the outstanding amount has crossed rupees 40 lakh crores as of March 2022. If we talk about developments in the banking sector, which includes a lot of innovations and a lot of the journey of banking industry, public sector banks owned roughly 90% of total banking assets in India, especially after 2 episodes of nationalization in 1969 and 1980. And after Narsimham Committee report of 1991, the dual regulation of banks was proposed to be removed. Interest rates were largely deregulated. SLR, that is statutory liquidity ratio, and cash reserve ratios were reduced to increase the productive capacity of bank capital. And more importantly, the banking sector started to get reorganized with the entry of private sector and foreign banks. The idea of introducing these new banks was to improve competitiveness of the banking system for better efficiency. Since commencement of these businesses, new age private sector banks are nowadays contributing a lot to the increased credit requirement of the economy. In last about 25 years, there has been a share in total credit which has increased from 3% in 96-97 to 36% in 2020-21. The bank credit to GDP ratio has grew from 26.7% in 1995 to about 52% in 2021. The number of public sector banks has reduced from 27, which were in 2017, to 12 as of June 2022. The number of private sector banks have remained constant at 21 during the same period. Then small finance banks were introduced. So the growth of total deposits and credit of small finance bank has been significant since March 2018. In March 2022, the deposit grew by 37.3% on year-on-year basis, while growth in credit portfolio was 25.6% as against growth rate of deposits and credit of SCBs at 10%, 10.2% and 10.8% respectively. Payment banks are also new entrants to this market. Payment banks are truly first generation new age differentiated banks designed on activity based functional differentiation. The payment banks facilitated a total of about 11.4 crore mobile banking transactions amounting to rupees 17,468 crores in June 2020, which has increased to 47.3 crores transaction with an aggregate value of 46,338 crores in just 2 years, that is August 2022. That means there's a growth of 4.1 times in terms of volume and 2.7% in terms of value. It's also important to highlight that as of August 2022, there were 2.5 crore active users of payment banks using their mobile banking facilities, representing about 2.7% of all active internet users in India. Now, what is all this indicating? This is indicating that the journey of financial system development has been really long. After 1991, the growth and the development and the innovation in this sector there has been a tremendous increase in that. And we are, as a regulator, we are trying to reach out to each one and everyone to bring more and more financial inclusion, to bring about financial literacy, and to ensure that nobody is unbanked in the economy. And for that also a lot of measures have been taken by the government appropriately. So all of this are a kind of innovation that has happened. Now, what is innovation? A general definition of innovation explains that they appear when new ideas, solutions and instruments are implemented in order to change the condition of business entity and to improve its situation. So anything related to that is innovation. The application of innovation increases the competitiveness of a business entity and create value for its owners. Now, J. Schumpeter has talked about traditional approach to technological innovation, and he talks about these 6 groups of innovation. So, these innovation can be related to the technological innovation, can be related to new products, new methods of production, opening new markets, new sources of supply of raw material, new organization forms and business structures, and new methods of management. So anything wherever something new happens which improves the efficiency can be termed as innovation. So moving on to what is financial innovation. So what do we mean by that? Financial innovation is creation of innovative financial products, services, institutions, markets and procedures. The potential for transformation in the financial sector is enormous due to acceptance and integration of new technology. So nowadays when we talk about financial innovation, technology gets imbibed in it. Now, what are the functions of financial innovation? According to Economic Council of Canada, financial innovation can be classified into 3 broad categories regarding their functions. So there can be market broadening instruments, there can be risk management instruments, and there are arbitrage instruments and processes. So the first category of financial innovation increases the liquidity of financial market. It improves availability of funds to deficit units and ensure that access to new investment opportunities to surplus unit happens. The second category of innovation enables to reallocate financial risk to those market participants who are less adverse to it or better prepared to handle with it. And last category of financial innovations gives the opportunity for the market participants to benefit from difference in cost and returns between the market. Another way of classifying innovation, financial innovation, is based on the function, and this has been given by Bank of International Settlement (BIS). According to this classification, there are 5 groups. Financial innovation can relate with price risk transferring, it can relate with credit risk transferring, it can relate with liquidity generating, it can relate with credit generating, and it can be equity generating instrument. So the first group of innovation provide the market participants with more efficient means for dealing with price or exchange rate risk. Credit risk instruments are used to reallocate the risk of default. Liquidity generating instruments can have 3 different consequences. They increase the liquidity of the market, they enable deficit units to look for additional sources of funds, and they allow market participants to avoid unfavorable law regulations. Credit generating instruments increase the amount of debt funds available to the deficit unit, and finally, while the access to additional sources of equity capital is provided by the use of equity generating instruments. So this is how BIS has tried to classify the financial innovation in different categories. If we talk about role of financial innovations, so again by BIS when this was given, so different roles can be played by financial innovation. One important role is risk transfer. So risk reduction or process or protection against all type of market risk, price risk, exchange risk, interest rate risk or credit risk by use of derivatives, securitization or collateralization process. So this can be role of financial innovation. When we talk about financial innovation and its role as risk pricing, the risk which are embodied in financial instruments can be stripped out, priced, held and traded separately from other risk of this instrument. For example, by the transactions in the secondary markets of CDOs or asset-based security. As a role to be performed for liquidity enhancement, increasing liquidity of assets or instruments, that is by securitization process, the loans can be traded in the secondary market and the asset structure of lending institution can also be improved. Financial innovations can lead to credit generation enhancement with widening the access to the credit market or increasing credit capacity both for borrowers or creditors by use of CDOs or CDS. Credit generation can be enhanced. For equity generation enhancement, increasing the access of equity financing together with more flexibility of capital structures, for example with the help of use of debt equity swaps or convertible assets, we can enhance the equity generation. In the insurance sector, there can be widening of possibilities to ensure risk in return of the payments of a premium. Asset and liability management, it can widen the scope of managing assets and liabilities like securitization, CDOs and CDs. Funding of financial institutions can be widened, securitization can help in this and improve the institutional fundings. So overall, what we have discussed till now is related to that how financial system, which plays a very important role in economic development of a country, has evolved till date. There are 4 important components including financial markets, institutions, regulators, instruments and financial services. Each one has an important role to play. And whatever developments that have happened till now, they have happened just because of all the innovations that have taken place in the financial sector. And with innovations, we all understand that growth also happens faster and we reach to higher levels of economic growth and place ourselves as a country in a better picture of development. That's all for now. In the next lecture, we are going to talk about financial innovations more. Thank you so much.